Well, welcome to our continuation on investment basics. All right, we left off with talking about indexed funds. And remember, indexed funds, mutual funds typically, or any index is really a snapshot based on a set of rules that whatever you want those rules to be. Now, the ones that we're most familiar with, the ones that we hear on the news every night, is the Dow Jones Industrial Average, and the S&P 500. Those are two very, very common indexes. One being about the top 30 companies in general. There's a little bit of nuance with that, but it's about the top 30 companies in the United States. And the other one is the top 500 companies in the United States. Again, a little bit of calculations behind the scenes that make them slightly different, but that's in general what they are. And you can set up rules for any index. Those are just two indexes that were made by a couple of companies. One was Standard & Poor's, the S&P. That's what S&P stands for. That company came up with that index. But you or I could make an index. I mean, anybody could make an index, but they're usually done by large investment firms or some recognized economic entity will make an index. And an index is really, again, a set of rules. So like, let's say in the case of the S&P, the rule is very simple. Choose the top 500 companies based on their value, and that's what it is. If you make the cut, you make the cut. If you fall off, let's say your company is no longer, it's now the 501st largest company, and you were, the 499th largest company, but something happened, and then you fell off the S&P. That happens quite a bit. Companies will fall off, and then they'll get back on as their size fluctuates. But those are rules that you can set in place that obviously a computer can do very easily in figuring out what those rules are. And indexes can be anything, again, as long as you set those, what the rules are for choosing what's going to be in your index. And the other very powerful thing about the indexes is that most human beings, almost all human beings, cannot beat an index. They if they're matched up against that particular index, uh, and they try to actively beat it, they can't, and that's been proven historically. And those people that try to beat it are paid millions and millions of dollars to try to do so, and they don't do it. So why do we pay them? I don't know why we pay them. These fund managers, you'll hear that on the news too about fund managers making $300 million a year. Um, Individuals making that much money, yet you couldn't beat an index run by a robot that cost nearly nothing to do. So that's where you really wonder and what value that you're getting with that. Now, it may be it may be satisfying your ego to invest in something exotic and cool and sounds like really tempting to do. It's not a boring old index fund. It makes you seem a little bit more sophisticated, right? If you're in some exotic mutual fund. But the reality is, might make your ego feel better, but all you really care about at the end of the day are the returns that you're going to get long term with your investments. All right, so that was it about index. Let's talk a little bit more and we'll continue through our list here. So the S&P, the Dow Jones, we've gone over that. There are other indexes out there, and you might hear these terms used: small cap and mid cap. What is that? The size of your hat? Well, the word cap is for capitalization. And capitalization, when we use it in this reference, is the size of a company. So you'll hear like, well, what's the capitalization or on Apple? It's basically taking all the stock, how many shares of stock are out there, and the cost of and the share price. And that is the value of the company. So it's really the value of the company. And you have small cap stocks out there and large cap stocks. And you have indexes that also appeal to those those ranges. So a small capitalization company would be a smaller company, and then you have these kind of middle companies, these middle capitalization companies, those middle names that you're not going to really be familiar with unless they're maybe in your backyard. These middle companies. Why would you want to invest in those? Because typically, when you look at the S&P 500 or the Dow Jones, you probably recognize all 30 of those names. The S&P, you might recognize, almost all of them, or maybe at least 400 of the names. You might recognize pretty clearly. Why not just do that? Why would you even want to think about some small or some smaller companies or middle companies? Think of this. What was Apple back in 1980? Apple was probably a small to mid cap company back then. So there's a lot of potential growth with these small and middle companies. Microsoft and Apple, they're not going to grow that much more. They may jockey for position over the years. Who's number one, who's number 10. They're not going to get too much bigger. I mean, they're already at the top of the heap as it is. So they may continue to grow, hopefully, or they could go the way Kodak did. Kodak was on the Dow and now it's gone. But there's really not too much hyper growth that you're going to get out of these areas, out of those companies. They will be tend to more stable. They'll be To make Apple disappear is going to take many, many years of mismanagement or poor product line for Apple to disappear. Same thing with like Microsoft. It will take many years for that to finally erode away to nothing. Um, these smaller companies and middle companies are more could be more risky. They could couple bad years, they're no longer existing. But they could also have the next, iPhone. They could be the next operating system like Microsoft was. The cheap operating system that business bought was MS-DOS, and that's really what propelled Microsoft into relevancy. Um, so there is some growth opportunities with these areas. So when you hear these mid cap and small cap, that's what that means, capitalization. And there are mutual funds and indexes that appeal specifically to those areas. And then there's international and global. Kind of, again, we're continuing our discussion on flavors of mutual funds. There's a lot more, trust me. There's all kinds of exotic mutual funds out there. These are the bread and butter ones, and these are the ones in general that we would really like you to think about as far as building your portfolio. All right, so going back to international and global, you want to be careful there, or just understand the differences. So international, when it's marketed in the United States, is really going to refer to companies that do their business outside of the United States or a large component of them. Global companies are going to be all over the place. So let's say Procter and Gamble. I mean, they're going to be all over the place. Now, if you remember Procter and Gamble, the big soap and manufacturer, and that's how most of us think of it, they were on the Dow as well. So you do have companies on the Dow, on the indexes, the Dow and the S&P 500, Apple obviously doing business all over the world, that do have a global presence. But international usually means anything but the United States. Global is all over. And where you want to be careful is that you could have overlap. So let's say you are getting exposure to other countries automatically when you buy an S&P index fund. Again, Apple does business all over the world. Why should you care about international anyway? Remember we talked about diversification. So one of the things is maybe the US economy isn't doing so well, but maybe China is going crazy. And maybe China really likes iPhones. So they may not be selling very many iPhones, let's say, for example, in the United States, but they're selling a ton in China. So Apple's still doing well. So a company like that has diversification in their markets. And again, markets will tend to, some will be hotter than others. Economies will be better than others. In general, that can happen. Also, you can have kind of these overall depressions and recessions that affect the entire world. And because we are so interrelated, usually these major events will cause contractions all over the place. If something happens in the United States and we have another recession, we're not buying as many Chinese goods. And then China's going to kind of go down a little bit. But So know that there is that total interconnectedness, but there is some differences too. So that's, doesn't necessarily mean that the Chinese are going to quit buying all the things altogether. And of course, they've got, I don't know, I forget how many, 1 point something billion people, maybe 2 billion, that still buy stuff domestically. So their domestic market still may be strong and may still want to buy iPhones, even though we may not be buying as many in the United States. So there you go. So there's a global company that can kind of diversify and still, maybe still have a good year, even though it's not doing so well in a particular region. And with your own diversification of your investments, you want to look at those companies. Whether if you just bought 100% U.S. companies doing business just in the U.S., um, you would be subject to a little bit more of that volatility because you don't have that diversification in those other parts of the economy. You've missed Europe, you've missed India, you've missed China, you've missed Japan, you missed all these other major economies in your investments. So that's why I guess that international, that global perspective is important to have some of that in there and to understand the differences. Global will be companies doing business all over the world, and international, more targeted to stuff outside of the United States. Okay, bond funds. We talked about what bonds are, and you can buy mutual funds in bonds. Okay, so you don't have to go out and buy a bond from a company, though you can, just like a stock. You can go buy a stock from a company. But it's better for diversification to have to invest in bonds through, again, a mutual fund or an even exchange traded fund. But because those funds are going to be able to go out and buy hundreds and hundreds and thousands of different companies and their bonds and have, diversification. Again, imagine if you bought a bond from a company. Well, let's pick one. Happened not too long ago in my memory. General Motors. Okay. Who would have thought General Motors would have gone bankrupt? And it did. And bondholders with General Motors lost quite a bit with that bankruptcy and their kind of their reconstruction and emergence out of bankruptcy. So if you just bought, oh, I believe in America and I believe in GM, I want to buy GM bonds, and you bought them, well, you maybe came away with nothing. But let's say you bought a bonds in all different companies, General Motors, let's say General Mills, you know, um, Apple. Or I don't think Apple's ever issued bonds recently, but I think they did not too long ago. But maybe one of those companies doesn't do well, but not the chances of all of them not doing well is pretty risk. So again, diversification, even with bonds, is important, and that's best done through a bond fund. Now, you might hear this too, that bonds, you'll hear ratings mentioned. Bonds are given grades. Just like you and I are given grades for courses, they're given grades as well. Why give a bond a grade? Well, you are a buyer of a bond. Even if you buy a mutual fund, they're acting on your behalf to go out and buy these bonds, and you want to know what you're getting. You want to know, how risky of a company are you? How is your financials looking? Do you have a lot of cash, or are you living day to day? You got great growth opportunities, or is it looking pretty slim? You want to know that. And these companies that want to issue a bond will actually pay to have themselves evaluated by a third party entity. So you'll hear these names mentioned: Moody's and S&P, Standard & Poor's, one of these big financial entities, will go in and look at a company and say, we're going to give you a grade. And based on that grade, you can then be able to sell your bonds better. Now, you would think that the better the grade, you want an A grade. Well, yes, you would want the top of the grade. Let me show you what the grades look like. You don't need to know this, but just know that if you ever hear these letters mentioned, I want you to understand, oh yeah, that's a bond rating that they're talking about. So here you can see that you got Moody's and S&P. They make this stuff up as far as how they do the letters. It's all their own. They decide their grading scale. They pick it. It's arbitrary. But you can kind of see the A's are great, and then as you start losing A's for both of them and you start getting into B's, not so good. Okay. So if you're a company and let's say you had a couple bad years, but you still look pretty good, but you're not as good as you used to be. But you need some bonds because you're going to build a bunch of new factories and you don't have any cash, so you want to go directly to the people and do some bonds. Well, let's say Moody's and S&P, you pick one of them, maybe both, but you pick one. They come in and they grade you. They say, you're going to be an A, right down here, an A. When you look at the S&P column and then down to the A. You're not an A minus, you're not an A plus, you're not a triple A, you're an A. Not bad, not bad. But you're not as good as a triple A. So what that means is people looking at you to buy it, you're going to say, yeah, I'll buy your bonds, but you're not so good. You're not a triple A, and you got maybe a little bit more risk, not a lot, but a little bit more. I want paid more because you're a little risky. So instead of giving me, let's say 5% a year, which that AAA company would pay me, you're going to have to pay me 7%. If you pay me 7% per year, I'll lend you some money because I think you're going to make it, and that makes it worth it for me. So it's that exchange. As your rating goes down, your investors are going to require a higher rate of return to assume that extra risk. Now, you also will hear this too, junk bonds. It's a junk bond. That is a bond that has a rating that's below what we call investment grade. So investment grade is going to be basically a lot of those B letters in there is investment grade. Not always. You can see the B's down here. You got to be careful which B you're getting. But those investment grade are going to be the kind of the ones that are pretty stable, probably not too much risk associated with that company. When you get into junk bonds and you start getting these ratings down here, the interest rates really go up for the company. It's like high risk, like when you go to these high risk lenders, oh yeah, we'll lend you money, but you got to pay us 12%, because your credit rating, that's what it is. It's a credit rating, just like you and I, a credit score. It's probably another way to think of it. If I have a great score, if I have an 804 score, I'm going to get the best interest rate the bank's going to give me. If I have a 675, the bank's going to charge me a little bit more in interest rates because I'm perceived as a little bit more risky. Same thing with bonds because they're out borrowing money from the people. At some point, it gets so expensive for them to borrow money, it's probably not worth it for them to do it. So there's that. So there's kind of junk bonds and investment grade bonds. Here's the takeaway point. The takeaway point is stick with investment grade. Don't even think about non-investment grade and junk bonds. Not unless you're into speculation, you just want to have fun, go for it. But if you lose your money, don't hurt yourself or your family investing in non-investment grade or junk bonds. And most of you are not going to invest in individual bonds. So you're going to buy these mutual funds that will be indexed to investment grade bonds out there. So when you look at a bond fund, look at investment grade only and look at investment grade only and again purchasing through, I guess, a mutual fund. So you can have that diversification with your bonds. Okay, so there's a little bit about bond funds, bond ratings, and investment grade, and staying away from anything that says, non-investment grade mutual fund. Don't go there. That's speculation and not to be taken seriously as a serious investor. Okay. Let's talk a little briefly about accounts, the different types of ways that you're going to, your general portfolios, what they're going to be flavored with. And we'll talk a lot more about retirement accounts, but just to give you the two, you invest things, but typically these buckets come in two different flavors. One is a taxable account, and one is everything else, which is the everything else are tax deferred accounts. And those fancy word for your retirement accounts, your 403bs, your IRAs, there's a typo there, but your 401ks, all those retirement accounts are tax deferred, meaning that those the monies in there that grow, you don't pay any taxes on them until you start pulling the money out at retirement. Then you pay Uncle Sam. They're not tax free, but you'll be taxed at retirement as you start using the money for day-to-day living in retirement. Taxable accounts, you're kind of taxed as you go. As the accounts grow in size, you're taxed on the growth. For many of us who have had a savings account, and if interest rates have been so low that past few years hasn't been very relevant, but let's say at a savings account, you would get a form, a 1099 from the bank that showed you how much interest you earned for the year on your savings account. You actually have to put that on your taxes, and you have to pay taxes on the interest. Same thing with investments that are outside of these retirement accounts, is that you have to pay on the growth of the investment because they grow in size. And then also remember the dividends. Dividends are also being generated as well, but you can think of that as growth too, because the dividends are coming into the mutual fund company, and they're not giving you a check. They're plowing that back in. In almost all cases, they're plowing that back into the mutual fund to buy more shares. So, but you will have your portion. Again, these things will be billions of dollars in size. You know, an S&P index fund run by a major fund company is going to be a billion in size. It's going to be huge. But you're going to have your little portion of that you're going to own, and you're going to have your own little tax liability associated with that too. So you'll get a little tax from the bank, and from the investment company that has the mutual fund, and you'll have to pay taxes on that as you go. Things are taxed at slightly different rates. I don't want to confuse you there. Just know in general the growth on things are taxed. There are two different tiers as far as how it is taxed, but it's relatively easy if you're using tax software. You just plug the things into different boxes. The growth of a stock is taxed one way, and your dividends are taxed another. But that's all provided on the tax forms that you're given. And if you're using, again, any kind of tax software, it's very fundamental just to plug it in the right boxes. But know that that's the two different ways to do that. For most of us, our largest accounts are going to be our retirement accounts. That's where we're going to be doing most of our investing. And what we've talked about here today in general can fit either both a taxable account and a tax deferred. Well, there's another question. Why would I even want one of these taxable accounts? Well, let's say you're investing for purposes outside of retirement. You know, you're thinking, you know, and you're going to want to think long-term horizon always with investing, always. Otherwise, you're a saver, okay? And for me, I think that that target is going to be like, and this is where there's some discussion, but honestly, I think you're looking at 7 to 10 years, more on to 10 to be an investor. Anything under that, you're a saver. Okay, so investors around 10 years time horizon before you start needing the money, and savers anything less than that. Just save it in a savings account. So, but let's say you're going to be you want to buy that cabin on the lake, you know, or you know whatever it is going to be, you know, the thing that you're going to do in 10 years, then you would have to do the taxable account. Tax deferred accounts, you're not supposed to touch that money until you've reached retirement age, which is 59 and a half is considered retirement age. Don't know where the half came from, but 59 and a half. And then you can start pulling the money out of the account without any really nasty consequences from the IRS. If you pull out money of a retirement account, you can, but the IRS is going to tax. They're going to get you with a penalty to do that. So just try it all possible ways to avoid withdrawing money from your IRAs and your retirement accounts, your 401k, your 403bs. The other term that we've talked about, but I don't think there was a lot of explanation in it, and that's dollar cost averaging. Dollar cost averaging is a great way And I would say there was only about a paragraph in the textbook, but I think for most folks, dollar cost averaging is in my opinion, is the recommended way to begin an investment, whether it's both a taxable or a tax deferred account. What dollar cost averaging does is that you put in a fixed amount. You decide, you're going what works for you and your budget. But let's just pick $100. You decide to put $100 into your retirement account, and you're going to be investing through mutual funds that we'll talk kind of the recommended portfolio of funds, but you're going to put $100 into these mutual funds every year. What dollar cost averaging does is you're going to do a fixed amount, that $100. Know that the markets will fluctuate, so that your mutual funds will increase and decrease in value. Now, what's the old adage? The old adage is buy low, sell high, right? Well, if you can figure out when to do that, you're going to be the billionaire. You're going to be the next Warren Buffett. Chances are you're not going to be the next Warren Buffett, because no one is going to be the next Warren Buffett. But dollar cost averaging really does it for you automatically. And here's how it works. So let's say I'm doing $100 every month, and my mutual funds, and I'm just going to simplify this. The share price this month is $25. Again, remember, each share I buy is going to be backed up by hundreds of different or thousands of different stocks. But let's say the entry level purchase to buy one unit, one share is $25. So this particular month I get 4 shares. Okay. Then next month the market increases in value. Okay, the share price is now 50. Okay, how many shares am I going to be able to buy? I can only buy 2. So I've bought, in the month that was down, I bought 4 shares at 25. The month that was high, I bought 2 shares at 50. So you're kind of leveraging out that risk. Now imagine how well you're doing. Do you remember the 4 shares that you bought at 25? Those are all now worth $50 a piece. And the ones that you've only bought 2 at 50, it might be the new high, it might be go down for a few months. But what it does is it really takes that volatility it takes the volatility and the questioning of how much on a share quantity to buy every month. If you stick to a disciplined dollar cost averaging approach, it will be averaged out for you and take away all that pain. You won't have any regrets. Let's say, for example, if you decided to purchase 4 shares every month, no matter what, there could be times when you're actually buying when the market is kind of overly inflated in price for some reason, because you said purchase 4 shares at 100. So let's say it went to 100, $400, and then it didn't reach that for another. It was a weird week, and for some reason the S&P went crazy for a week, which we've seen happen. Has made some weird jumps occasionally. And then you're kind of stuck with those 4 shares that you bought at $100, when really it kind of the price drifted back down to a more normal range of 25 to 30. So it takes all that volatility, that question of timing, takes it all out. And you can see there's wonderful math behind it, but it's really the best way to do it. Think of it this way too. Let's say you had a lump sum of money, $10,000, and you were fell out of off the back of a truck or somewhere. You got $10,000, and you decided, okay, today is the day I'm going to invest that $10,000 into an S&P 500 no load, low expense ratio mutual fund. Great. But let's say today was not the day, because today was the market high for the year. And you're like, wow, I invested that, back on X and X date, and it's just tanked. It's just gone down every day after that. Now, true, that can happen. But let's say you took that $10,000 and said, let's dollar cost average in. Let's do 500 a month. You're going to take that volatility of when to go into your investment. You're going to take it out of it, because you're going to diversify how you enter the investment over a period of time. So even with and when I would advise clients, and that often there'd be a large lump sum of money. Our approach was to enter the market through a dollar cost averaging strategy. So I like to think that I saved some people from potentially making some mistakes. Now, of course, you could have, oh, I got to get in the market today. Today is the lowest day of the market. Let's get it all in. Okay, if you really think that is the case, good luck to you. Because again, no one's been able to historically predict that with any accuracy. You can speculate that today is the lowest day and move all your money into the market. Um, and you might be right, but odds are not in your favor. Let's just put it that way. So dollar cost averaging, I highly consider you to do that. And most of us do that automatically through our retirement accounts. So, through your employer, you're going to say, please put in X amount every 2 weeks. X amount, whatever that is, coming out of your paycheck, goes in automatically every 2 weeks. So it's great. It already works out for you. Okay, so dollar cost averaging, I'm a big fan of that. And timing the market, I said over and over again, I won't beat that too much that horse too much, but it's impossible. You cannot time the market. When the high is, when the low is, try to tune out all that noise because that's all it is. It'll just increase your anxiety, and there's just no way. No one's been able to do this. Some have won a lot, but I say won. They speculated and they've won, but many, 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 many more have lost. So don't try to time the market, and dollar cost averaging is a way to defeat that timing of the market fallacy. Okay, know your age in bonds. We're going to look at portfolios in here in just a second, but I really think this is solid advice. Please seek out your own advice, do your own research. But when you build a portfolio, and again, I'll show you a portfolio, the only portfolio you'll ever need, and that comes right out of the textbooks. So much why I like that textbook. And you see, once you look at it, it's not really rocket science. It's very simple. And that portfolio is nearly impossible to beat. So I'll take that portfolio any day. And I've put millions of dollars into that style of portfolio for clients. But know your age in bonds. What that means is, let's say you're 30 years old. Okay, so you're going to want to have a portfolio, and basically it's going to be stocks, equity, through indexed mutual funds, and bonds, investment grade, through indexed bond funds, right? When you're younger, you have a longer time horizon, and typically it's retirement. Okay, so keep that in mind. Retirement is usually what we're focusing on. If it is something different than that, you're going to need to adjust kind of this conversation a little bit to fit that time horizon. But with your age in bonds, with that rule of thumb, is you're 25 years old, you would want to have 25% of your portfolio in bonds. The rest of it you're going to have in those equities and stocks through those indexed mutual funds. So 75% in stock mutual funds and 25% in bonds. Why? Well, bonds are going to be kind of your tried and true, boring. They're not very exciting. I'll get that. That's when people don't like them because they're not exciting, but they just kind of plod along and just kind of make their money. Okay, especially those investment grade ones. So that's why those are kind of the stabilizers of your portfolio. And why only 25%? When you're young, again, you got a lot of time to ride out all the ups and downs. But as you age and you get closer to the point in time where you're going to start pulling that money out and using it for day-to-day expenses, as you get older to that time, you're going to want to reduce some of that volatility down. So let's say now you're 50 years old. You're going to want 50% in bonds and 50% in stocks. You're 75% old. You're going to want 75% in bonds and 25% in stocks. So you're kind of, those bonds are going to be a lot less volatility to them. And that's what you want. You want very little volatility as you start pulling money out of your investment portfolio. And the age in bonds is the great, I can't find any other advice that beats that. And also knowing your risk tolerance. So that's the general advice. When I always talk to a client, And this is, I guess, where in using an investment advisor. Again, I was an investment advisor, Series 7, property, life, health, casualty insurance. I could sell it all, do it all, options, all that stuff. The the uh, the the rules of thumb don't always work for everybody. So the know your agent bonds might work, but you really personally need to know your own risk tolerance. How freaked out are you going to be by seeing, opening your statement and noticing that it's down a little bit? If you're going to be if it's going to keep you up at night, cause you anxiety, then maybe the rule of thumb portfolio isn't for you. And that's okay. You need to recognize that, because the worst damage you can do as an investor who's investing, not speculating, who's investing for the long term, is to deviate from your plan significantly. And the significant deviation is I want all of my money out of the market today. That is the potentially the worst move people can do, because once you go out, you have, let's say, and they usually do that during a panic, a recession hits. I've been in my life, I have conscious memory of 3 recessions. 70s, a little bit in the 70s. Well, actually, 70s, there's one almost about every 10 years. 70s, there was one in the 80s, kind of during that Reagan administration. We had one in the 90s, and then we had the worst one of all was the Great Recession, in kind of in the '08 housing crisis and all that. So these things seem to happen about every 10 years. And pulling out when one of these things really starts taking off is the most disastrous thing that you can do. It's the whole timing issue. I mean, you've pulled out of the market at the low, and well, when do you go back in? It's timing that's impossible. Um, and once you pull out, your losses are then permanent. You've really locked in your losses. So, because again, timing to go back in is again nearly impossible. But so what you want to do is build your investments so that you don't freak out too hardly, that you don't go on the computer and say, sell all my index mutual funds, that you have a nice broad perspective, through that. And again, you may be 25, but if you feel more comfortable investing like a 50-year-old, do it. Okay? You're still going to be better off. So keep that in mind. Customize this to your own risk preference. You don't want to cause yourself anxiety, and you definitely don't want to cause yourself to do something, especially during a doom and gloom situation, that will end up hurting you. And using an investment advisor, I'll talk about this. So of course, I made a career. I made my wages on being an investment advisor. And I've talked about kind of why I've separated from that, and I actually went from that to decided to do a career in helping others in healthcare. And investment advising allowed me to do that. Actually, I was able to quit my job, and I had 3 years off to retool my entire career. And investment advising allowed me to be able to have that tremendous luxury. Most people don't have that kind of luxury in life. I had that once, and that's what I did. So an investment advisor, but ultimately, when I looked at at being an investment advisor, and why it didn't enrich me or value me, is that what I did like is educating clients about how to do these investments. But I knew that this is actually quite simple. Anybody can do it. You could watch this video and pretty much conceptualize most of the information here that most people would need to make a very successful investment life. It's not too difficult, and yeah, it takes a little homework and a little reading every now and then, but it wasn't too bad. I enjoyed that educational piece and helping people with that. Um, but it comes at a cost, and that's knowing that clients could do things at a much cheaper cost, quite frankly, than dealing with me. So I always hope that I added value in at least helping them to build the right portfolio. even though that part was relatively easy. For me, it's relatively easy. Once you see this, it's relatively easy to do. Understanding their risk tolerance and adjusting the portfolio to that risk tolerance, easy to do. Um, and making sure they didn't do those tragic errors like pull out of the market, when things were bad. And doing things like fundamental. Again, I'm a big fan of dollar cost averaging, doing it that way. Even though, they might have $500,000 and they want to invest today, um, knowing that the best way, in my opinion, to enter the market would be to ease that money in over a period of time. So ultimately, I think for you or I, using an investment advisor, they can be very, very valuable. Um, Particularly if you have a complex situation, especially a complex tax situation, maybe an inheritance situation. um, I would say consider using them. Shop around, ask questions, straight up, ask them, how do you get paid? You want that to be completely transparent. There have been a lot of changes in the industry, changes to the good since I've left. Um, the biggest one is that it just started in the industry, but it's something called fee based, and I do agree with fee based advising, and what that means is that your advisor will charge you a fee every year based on the size of your portfolio. Portfolio not doing well, they're not going to get paid as much. Portfolio doing good, they're going to get paid more. They have a definite connection to you through compensation on how your performance works, on how your investments do. That wasn't always the case. So an investor could sell you something and the performance of that investment was completely irrelevant to how they get paid. How they got paid was commission, those loads that we talked about behind the scenes that customers would pay up front, but it would have no connection to the relationship to the client and to their ongoing investment. So ask some pretty brutal questions when you look at an investment advisor, and there's definitely some great ones out there, and especially for high net worth individuals. And some of you statistically will become high net worth individuals. Remember those four ways of wealth creation? Could be inheritance. That's usually the biggest one. And that could happen. So do seek out one if this situation is complex, and then it warrants it. But for most of us in general, we can do this without an investment advisor. All right, so let's take a look at. We've talked about the portfolio. Let's talk about kind of the only portfolio you'll ever need. Now, this is highlighted in the textbook, and I absolutely love it. So keep in mind that the way it reads, you have 60% stocks and 40% bonds. This is assuming someone who's 40 years old. So those two categories will change over time as you age. Okay. And then you have percentages as far as recommended percentages. I think these are very solid in what you're looking at. So with the equity portion, the stocks, 70% in that S&P index fund. That's going to be, that those top 500 companies, traded. Okay, so you got those. You've got the small cap index fund. Again, there's a ton of them out there. Again, you're going to look for no load. You're going to look for no load and their expense ratios as well to be relatively low. I would definitely look at anything below 0.5%. So it's going to be like 0.50%. You should be right around that range or less. And then 15% international fund. That's just with the equity portion. Now, when you look at the far right-hand column, this is the overall portfolio size. Okay, but within equity, 70%, remember stocks, equity, same thing, 70% index, 15 small cap, 15 international. That's going to give you really good exposure internationally. You're going to get good global exposure through the index, plus a lot of domestic, okay, in the S&P index fund. Small cap, you're going to be able to hopefully see a little bit more growth on that side. It's going to be a little bit more volatile, but basically the next Apple, the next Microsoft, the next Alphabet. Alphabet, by the way, is Google. They changed their name. The next Alphabet, I mean, and Google's just, I mean, that's a baby. That place has only been around for a few, maybe what, 10 years, 12 years. That's a baby still. So, capturing the next Google, through these small cap index funds. So you might see some nice growth in there. But even though it's a smaller percentage, so it's going to be more volatile. So let's say that it doesn't do so well. Your big tried and trues are going to be in there. Your 70% S&P index fund, your international fund, that's going to be in there. So you're going to diversify that volatility out. And then bonds, you're going to choose those investment grade, longer term, no load, low expense ratio bond funds, and to be for that percentage of bonds. And this will be in your age range. So this, again, this is a portfolio and tweaks to this. I mean, yes, the rule of thumb says your age in bonds, but again, look at your time horizon. If you think about if retirement is, let's say, 65 years of age, and you're investing for 10 years, okay, it's almost as if you were a 55-year-old. So you'd probably want 55% in bonds, and then the 45 in stocks, and ease that down every year. So here's another thing that we didn't, one last thing, or I'll leave you with too, is that with this portfolio, there is something called rebalancing, and you will want to do that. You will want to go in. Now, some of your investment companies, the online typically, they're all online nowadays, so you're going to be able to find one. But you want a low cost Scottrade or E-Trade, Ameritrade, some of those ones, relatively low cost. Some of them will have automatically rebalance your portfolio for you. What does rebalancing mean? Well, you're going to start investing, and you're going to do these 70% and 15% and 15, and then 100% in the long-term bonds, and you're going to have your 60 and then your 40% overall, okay? But over time, things are going to grow, and they're not going to grow at the same rate. So imagine if you did nothing. You still put money in. You still put 60% of your money into the stock funds, and you still put 40 in, but you didn't rebalance. And then let's say 5 years, you look at your portfolio, and you go, wait a second. Why is my small cap fund? My small cap fund overall only should have been about 9% of my portfolio, but it's now 25. How did that happen? It grew faster than all the others. And subsequently, as it grew faster, now that it's 25% of your portfolio and you didn't touch it and you didn't rebalance, all of a sudden your portfolio is a lot more volatile. So you do want to go there regularly, at least annually, and rebalance your portfolio back down to these percentages. It just means moving some money around in the buckets, and often that can be done at little or no charge, is rebalancing. So that's what's great too. It's pretty cheap, if not no cost at all, to move the money around in buckets, especially if the mutual funds that you're picking are these index funds, which I highly recommend, and they're all with a very low cost company. Again, Fidelity, or there's a Vanguard is a great one. If all of your they usually allow you to do intertrade exchanges without any additional costs in there. So that's great. So you can rebalance back down to your overall percentages, because they will get out of whack over time, and they naturally will, because the higher volatility or the higher risk things will grow faster. So your portfolios will actually become more volatile, more up and down movement, if you don't rebalance. So keep that in mind. So you're going to rebalance your overall portfolio to these, kind of these general percentages here, also in tune with the overall portfolio. When you look at it, 60% in stocks and 40% in bonds. That's the 40-year-old. You're going to want to make sure that you add up these totals on the side. So you do have to have some comfortable familiarity with percentages and how those work. But I think you can get this. The math is not too hard. As long as you know how to kind of work what percentages are going to be in there. That you again, this is what it would look like for that 40-year-old. Now these percentages will change over time. Again, another rebalancing required as you age. So don't forget to rebalance. Also, one nice thing about what I would look for, not necessarily um, a deal buster, but almost all investment companies or mutual fund companies will allow you to dollar cost average. They'll do a direct debit right out of your checking account at no cost. So look, that's kind of a nice feature. They almost all have it now, but it is something you do want to look for. All right, so that concludes our discussion on a lot of investment topics. I think a lot of the basics I've covered here with fundamental investments. We're going to repeat and echo some of these as we talk about retirement plans, which is again the most largest investment most of us will have. So take some time. I know there's a lot of lecture material here. Nothing that's not echoed in the textbook or that won't be on the quiz. So it's fine if you don't get through all of these lectures in this particular module, but hopefully you have had time to review all of that. I think it's essential information out there. All right. Well, thank you very much, and I hope you found this informative.